Three forces are building simultaneously in global markets right now. Oil prices are rising, sovereign nations are selling US Treasuries, and the US dollar is strengthening. Each one alone would be significant. Together, they create a high-pressure environment that affects Bitcoin and gold in ways that most investors do not fully understand. Today, we break down exactly how these three forces interact, why they move both assets in directions that often surprise people, and what investors in Bitcoin and gold need to watch. Welcome back to Bitcoin Capital Gold. If you are investing in Bitcoin or gold, knowing when to scale in and when to defend your position is critical. Bitcoin Capital Gold is built for investors who want clear, no-nonsense analysis to make rational, confident decisions. In today's macro analysis, you will understand why a rising US dollar suppresses both Bitcoin and gold, how surging oil prices feed through into bond yields and dollar strength, why sovereign states selling US Treasuries amplifies all of these pressures simultaneously, and what the short-term and longer-term implications are for both assets. These three forces do not move in isolation. They form a chain reaction, and understanding that chain is essential for anyone holding or trading Bitcoin or gold right now. The US dollar. Why its strength matters so much. The US dollar is the world's reserve currency. Almost every major commodity, oil, gold, agricultural products, is priced in dollars. That single fact creates a relationship that runs through every asset class on Earth. When the dollar rises, the purchasing power of every other currency falls relative to it. And when purchasing power falls, the cost of buying dollar-denominated assets rises for every buyer outside the United States. For gold, this relationship is direct and well-established. Gold is priced in US dollars. A European investor, an Asian central bank, a Middle Eastern sovereign fund, they all pay in their own currency first and convert to dollars to buy gold. When the dollar strengthens, they need more of their local currency to buy the same ounce. Demand from international buyers contracts. Price falls. The inverse relationship between the dollar and gold is not a coincidence or a short-term quirk. It is a structural feature of how gold is priced and traded globally. For Bitcoin, the relationship is less mechanical but equally real. Bitcoin is also primarily traded and priced in US dollars. A stronger dollar reduces the relative attractiveness of holding Bitcoin for international investors. The same logic applies. Beyond the pricing mechanism, a stronger dollar typically signals a risk-off environment. Capital is moving towards safety and liquidity. Bitcoin, despite its growing maturity as an asset class, still behaves in these environments more like a risk asset than a safe haven. When the dollar surges on fear or instability, Bitcoin tends to come under selling pressure as investors reduce exposure to assets perceived as higher risk. Rising oil, the inflation engine that drives everything else. Oil is not just an energy commodity. It is an input cost for almost everything the global economy produces. When oil prices rise sharply, the cost of manufacturing, transportation, agriculture, and energy all increase simultaneously. That broad-based cost increase feeds through into inflation, not gradually, but quickly and across the entire economy. Rising inflation has a direct consequence for central bank policy. The Federal Reserve and other major central banks respond to persistent inflation by raising interest rates or by keeping rates higher than markets anticipated. When rate expectations shift upward, the US dollar strengthens. Higher rates make dollar-denominated assets, bonds, cash deposits, money market instruments, more attractive to global capital. That capital flows into the dollar, strengthening it further, and the pressure on gold and Bitcoin intensifies. There is also a second channel through which oil affects gold specifically. When oil-driven inflation spikes sharply, investors who hold leveraged positions across multiple assets face pressure from rising costs and falling asset values. In those moments, gold, as one of the most liquid assets in the world, becomes a source of emergency cash. Investors sell gold not because they have lost confidence in it, but because it is the most convenient asset to liquidate quickly. This is known as a liquidity-driven sell-off. It is temporary by nature, but in the short term, it can produce significant price drops in gold that appear to contradict its safe haven role. Bitcoin faces a similar dynamic in a high oil, high inflation environment. Rising inflation without a corresponding rise in risk appetite is not a supportive environment for Bitcoin. The narrative of Bitcoin as an inflation hedge works best when inflation is rising moderately and interest rates are low or falling, conditions that reduce the opportunity cost of holding a non-yielding asset. When inflation surges and interest rates follow, that narrative weakens. Cash and bonds become more competitive. Capital moves away from Bitcoin toward yield-bearing instruments. Sovereign Treasury selling, the force most investors overlook. The third force in this equation is the one that receives the least attention but carries some of the most significant implications. Sovereign nations like Japan, China, Middle Eastern states, and others hold large quantities of US Treasury bonds as part of their foreign exchange reserves. These are not passive holdings, they are actively managed, and when a sovereign state's own economic conditions deteriorate, or when they need to defend their own currency, they sell those treasuries to raise dollars. When large holders sell US Treasuries, the supply of bonds in the market increases. When supply increases, prices fall. When bond prices fall, yields rise, because yield moves inversely to price. Rising Treasury yields are significant for two reasons. First, they make U.S. government bonds more attractive as an investment, offering higher income with sovereign backing. That draws capital away from non-yielding assets like gold. Second, higher yields strengthen the dollar further because international investors need to buy dollars to purchase those higher-yielding U.S. bonds. The sovereign selling creates a chain reaction. More bonds in the market, higher yields, stronger dollar, and additional pressure on gold and Bitcoin simultaneously. Japan is the most significant example of this dynamic right now. Japan holds approximately $1.13 trillion in U.S. Treasuries, one of the largest foreign positions in U.S. government debt in the world. Japan's own fiscal position is under significant strain, with government debt exceeding 250% of GDP. As Japanese bond yields rise and the yen weakens, the pressure on Japan to sell U.S. Treasuries to manage its own currency and liquidity needs increases. A large-scale Japanese Treasury sell-off would send U.S. bond yields sharply higher, with direct consequences for the dollar, for gold, and for Bitcoin. China presents a similar risk. China holds over $700 billion in U.S. Treasuries. In periods of trade tension or economic stress, China has the capacity and at times the incentive to reduce those holdings. A coordinated or even gradual reduction in Chinese Treasury holdings would add to bond supply, push yields higher, and strengthen the dollar in a way that creates significant headwinds for both gold and Bitcoin in the near term. How the three forces combine. The chain reaction. Individually, each of these forces creates pressure on gold and Bitcoin. Together, they form a self-reinforcing cycle that can be difficult to break without a significant change in one of the underlying drivers. The sequence typically runs as follows. Oil prices rise, driven by supply disruption or geopolitical conflict. Rising oil feeds inflation expectations. Inflation expectations push bond yields higher as markets price in central bank tightening. Sovereign states, under their own fiscal pressure, begin selling U.S. Treasuries, adding further supply to an already pressured bond market and pushing yields higher still. Higher yields attract capital into dollar-denominated bonds. Dollar demand surges. The dollar strengthens. Gold, priced in dollars, becomes more expensive internationally. Demand falls. Price drops.
Bitcoin, perceived as a risk asset in this environment, faces selling pressure as investors reduce exposure to assets perceived as higher risk. Both assets are caught in the same current, being pulled in the same direction by the same underlying forces.
The short-term picture for both assets in this environment is difficult. For gold especially, the combination of a stronger dollar, rising yields, and liquidity-driven selling can produce sharp corrections that look alarming when viewed in isolation, but need to be understood in the context of what is driving them. The fundamental case for gold as a long-term store of value does not change because oil spiked and Japan sold some treasuries. But the price can move significantly against that fundamental case in the short term when these forces align. The longer-term picture, when the pressure reverses. None of these forces are permanent. Oil prices do not rise indefinitely. Supply responds, demand adjusts, geopolitical situations evolve. Treasury selling by sovereign states is constrained by their own reserve management needs. They cannot sell unlimited quantities without damaging their own positions. And dollar strength, driven by fear and risk-off flows, typically reverses when the underlying fear subsides. When these forces begin to reverse, when oil stabilizes or falls, when treasury selling slows, when the dollar peaks and begins to weaken, the pressure on gold and Bitcoin reverses with them. Gold's longer-term relationship with this environment is particularly important to understand. Persistent inflation, even after the acute oil shock passes, is typically positive for gold over a multi-year horizon. If central banks are unable to fully contain inflation without triggering a severe recession, real interest rates, the rate of return on bonds after adjusting for inflation, can turn negative. In a negative real rate environment, the opportunity cost of holding gold essentially disappears. Gold becomes highly attractive. The very conditions that create short-term pain for gold often set the stage for its strongest subsequent rallies. For Bitcoin, the longer-term picture in this environment depends heavily on whether it continues its transition from risk asset to monetary alternative. If Bitcoin's institutional adoption deepens and its role as a reserve asset becomes more established, its sensitivity to short-term dollar moves and risk-off episodes should gradually diminish. That transition is not complete, but it is advancing. Each cycle in which Bitcoin weathers macro pressure and recovers reinforces the narrative of durability that institutional allocators need to see before committing meaningful capital. What investors in Bitcoin and gold should focus on. Understanding these dynamics is not about predicting exactly when each force will reverse. It is about knowing which signals to watch so that changes in the macro environment are not a surprise. For the dollar, watch the DXY index around key psychological levels, $100 in particular. A sustained break above $100 that holds on a closing basis intensifies the pressure on both gold and Bitcoin. A failure at that level and a reversal lower is one of the most direct positive signals either asset can receive from the macro environment. For oil, watch whether the current price level reflects a temporary supply shock or a structural shift. Temporary spikes driven by geopolitical events tend to reverse as markets adjust. Structural increases driven by sustained supply reduction or demand growth are longer lasting and carry more sustained inflationary pressure. The distinction matters for how long the current pressure on gold and Bitcoin persists. For Treasury yields, watch the 10-year US Treasury yield as the primary reference point. Yields moving sharply higher signal increasing pressure on gold and Bitcoin. Yields stabilizing or falling signal that the bond market is beginning to price in either a slowdown in Fed tightening or a flight to safety into bonds, both of which can provide relief for gold and Bitcoin. And for sovereign treasury selling, watch Japan specifically. The Bank of Japan's policy decisions and the trajectory of Japanese government bond yields are the most important single variable in the sovereign selling story right now. Any signal that Japan is intervening to defend the yen by selling US Treasuries at scale is the development most likely to accelerate the yield and dollar dynamic described in this analysis. Key takeaways. A rising US dollar, surging oil prices, and sovereign treasury selling form a chain reaction that creates near-term pressure on both Bitcoin and gold. The dollar's strength reduces international demand for both assets. Rising oil drives inflation and pushes bond yields higher, reducing gold's appeal relative to yield-bearing alternatives and increasing selling pressure on Bitcoin as a risk asset. Sovereign treasury selling amplifies yield rises and dollar strength, intensifying the pressure on both. In the short term, both assets can fall meaningfully in this environment, and those moves can be sharp and fast. The longer-term picture is different. Gold's role as an inflation hedge reasserts itself once the acute phase of dollar strength and yield pressure peaks. Bitcoin's transition toward a monetary reserve asset, while incomplete, continues with each cycle. The signals to watch are the DXY at $100, the 10-year Treasury yield, oil's price trajectory, and Japan's bond market. Those four will tell you when the pressure is building and when it is beginning to reverse. If you found this analysis useful, consider liking and subscribing so you don't miss our next video. Which of these three forces do you think poses the greatest risk to Bitcoin and gold right now? Share your view in the comments below. At the heart of the new global financial economy will be Bitcoin and gold. If you want to be ahead of the curve, follow this channel.